Bruyette joins me now. So, Dan, we've seen oil and gas prices come way down. That's a good thing. But could we see a spike in energy costs as the demand for energy grows in these spectacular ways?
Well, David, thanks for having me today. I do think you're going to see some spikes in certain parts of the country. It's just unavoidable at this point. The country has underinvested in some respects in our infrastructure and our grid in particular. We haven't built enough generation in the near term to satisfy this oncoming demand that we see. We've had a number of retirements of electricity generation facilities across the country. We have to slow down those retirements, and we have to start building new baseload power. So in the near term, there will be some scarcity in the marketplace, and that, of course, is going to drive prices up. On the long term, however, I do think that we have a once in a generation opportunity here, given the amount of hyperscalers that are coming into the market and who are willing to contribute and be a part of the building of this new grid. As was pointed out in Michigan, they are willing to participate, and I think we need to take them up on that offer.
Well, as you heard from Madison, OpenAI is calling for an additional 100 gigawatts of power every year to keep up with the demands. Where specifically would that energy come from? That's a lot of energy.
Imagine waking up to discover that one decision, one contract rejection, one policy shift from a single African nation just wiped $8 billion off the books of major U.S. energy firms overnight. No warning, no negotiation leaks, no buildup, just a sudden shock that sent markets scrambling. Washington recalculating, and analysts asking the same question. How did Nigeria pull this off? Because this isn't just about oil. This isn't just about one deal. This is the kind of move that forces the world to pay attention, the type of geopolitical moment that makes superpowers uncomfortable. For decades, Nigeria was treated as just another oil supplier, a place where Western energy giants expected easy access, low-cost extraction, and contracts that heavily favored their interests. But something changed, and it didn't happen quietly. In a stunning turn, Nigeria rejected U.S. oil terms, walked away from long-standing contract structures, and refused conditions that American energy companies assumed would be accepted instantly. And when Nigeria said no, the ripple effect was felt across an entire global industry. Washington was caught off guard. Stock analysts were blindsided. Energy firms connected to the rejected terms saw billions in projected revenue vanish instantly. Because for the first time in a long time, Nigeria wasn't negotiating from a place of weakness. It was negotiating from a position of power, power built on new policies, new economic strategy, new alliances, and a continental momentum that has been quietly growing across Africa for years. And here's the truth few analysts are willing to admit. If Nigeria can do this, other African nations can do it too. One bold move from Nigeria is now raising new questions. Is Africa entering a new era of energy independence? Are Western multinationals losing influence on the continent? How will this reshape the global oil map? And most importantly, what happens now that Africa's biggest oil producer has taken control of the negotiating table? This moment is bigger than one deal, bigger than one loss, bigger than the $8 billion headlines you've seen. Because what happened between Nigeria and the United States is part of a much larger story. A story about global power shifting, alliances changing, and African nations taking command of their own economic futures. If you think this was just a business disagreement, you're missing the entire picture. This was a message to Washington, to Western investors, to global financial markets, and to every country that has underestimated Africa's strategic rise. Nigeria didn't just reject a deal. It reset the rules. And today, we're about to break down exactly how Nigeria made the boldest energy decision of the decade, why U.S. companies never expected it, why it cost them billions, and what this means for the future of global energy, geopolitics, and Africa's long-awaited resource awakening. Stay tuned, because what you about to hear may reshape the way you see Africa's place in the world. And trust me, the real story hasn't even begun. For more than 60 years, oil has been the backbone of Nigeria's economy. From the moment large reserves were discovered, global superpowers and major multinationals moved in fast. The United States, along with several European countries, established deep footprints in Nigeria's oil sector. These agreements often gave foreign investors favorable terms. Lower taxes, production sharing structures formed decades ago, and operational control over large blocks. Nigeria benefited, but not nearly as much as it should have. Billions flowed out of the country each year. Revenue leaks persisted. Environmental concerns grew. And the Nigerian public saw limited improvement in living standards despite massive oil output. For decades, Nigeria wanted to renegotiate many of these agreements. But global pressure, economic dependency, and political instability made it difficult. But then, something changed. Over the past decade, Nigeria has been implementing reforms aimed at correcting long-term imbalances. A new focus on transparency, local participation, and stronger national control has emerged. These reforms directly challenged old structures. And that's where the conflict with U.S. companies began. Nigeria's government rolled out bold policies with clear goals. 1. Increase government revenue. For years, Nigeria was earning less per barrel than its potential due to outdated contracts. The new policy demands fairer revenue sharing. 2. Strengthen local ownership. Nigerian companies are now prioritized in bidding rounds and joint ventures. 3. Modernize the energy sector. New pipelines, cleaner refining strategies, and reduce dependence on imported fuel. 4. Limit contract terms that disadvantage Nigeria. This is the part that directly clashed with U.S. oil companies. When American firms presented terms that aligned with the old way of doing business, Nigeria rejected them outright. The message was clear: we're not going back. This is a new era. When Nigeria walked away from U.S. proposals, it triggered an immediate market reaction. Analysts had already calculated expected profits from the potential deal. Investors priced this into long-term forecasts. Production estimates were included in future revenue charts. So when Nigeria rejected the terms, contracts tied to U.S. firms lost projected earnings. Future drilling plans were halted. Share prices dipped. Analysts revised forecasts downward. This totaled an estimated $8 billion in lost future value. It wasn't a literal overnight collapse. It was the market's reaction to a sudden shift in expectation. 10 years ago, this move would have been risky. Today, Nigeria is operating from strength. New alliances with China, India, Middle Eastern energy firms, rising African continental cooperation, a global shift toward multipolar partnerships. Nigeria's growing tech and financial sectors, regional influence in West Africa, OPEC membership, giving it global leverage. In simple terms, Nigeria is no longer dependent on any single superpower. This independence gave Nigeria the confidence to reject terms that didn't benefit its long-term goals. The world responded fast. Washington, surprised, diplomatic, careful. Statements emphasized continued cooperation. A sign the U.S. wants to keep the door open. American energy companies, unprepared. Many expected negotiations to be automatic renewals. Other African nations, inspired. Countries like Angola, Ghana, and Namibia are now discussing reviewing their foreign oil agreements. International energy analysts, split. Some say Nigeria is taking a bold leadership role. Others say the U.S. will come back with a stronger counteroffer. But everyone agrees on one thing: Nigeria has changed the conversation. This rejection is symbolic and powerful. For decades, Africa exported resources but didn't control the value chain. Nigeria's stance shows a shift toward resource ownership. Fairer contracts, stronger negotiation power, economic sovereignty. It signals to the world that African nations are no longer passive resource providers. They are active players shaping global energy policy. Experts predict several outcomes. 1. Renegotiation. The U.S. may return with improved terms. 2. More competition. Other nations will offer Nigeria better deals. 3. African unity grows. Countries may coordinate energy policies more closely. 4. Nigeria gains leverage as the largest African oil producer. Its decisions influence regional policies. 5. A global shift begins if multiple African nations reject outdated contracts. Western influence in Africa will change significantly. Nigeria didn't just reject an oil proposal. It redefined its relationship with the world. This moment represents something bigger than a contract or a market loss. It represents a rising continent, a shifting global landscape, and a new chapter in geopolitical history. Africa is no longer waiting to be invited to the negotiating table. Africa is building its own table, and Nigeria just took the first seat.